only have a handful of hours until the end of the first quarter for this year. So we have a lot to talk about in terms of fundamentals and technicals. Joining me today is Stephen Guilfoyle of Sarge 986. Sarge, great to have you here today.
Thank you for having me, Remy. The pleasure is mine.
Well, we have a lot to talk about given that we'll be heading into the second quarter next week. Now, this was the first quarter that we had President Trump in the White House. And so far, we've seen that the attempt at repealing and replacing Obamacare has failed. Now, the Trump rally is also fading right now. So given what's happened in the fundamental space, what do you expect to see in equities in Q2?
You know, it's very interesting. The political risk, which seemed so great, seems almost to have been calloused over at this point. It's almost as if markets have been trading somewhat sideways and aren't really concerned all that much. The leading sectors going into the second quarter, outside of healthcare, which is a political football, have been the techs and the discretionaries, which really would lead you towards the idea that the pro-growth, the pro-business trade might still be on. So I'm not all that discouraged, really. I think they might make another stab at healthcare. That might actually slow us down, but it also lays the groundwork for a better, more robust tax reform, which everybody on both sides of the aisle really should be looking for.
And Sarge, when it comes to any sort of reform, we know that it'll take plenty of juggling in terms of politics and plenty of time to enforce. At least for the short term, this week we saw a boost in consumer confidence, and today we got the final GDP revision for the final quarter of last year here in the U.S., and we saw a small uptick to 2.1%. So given that we have more Fed speeches before the end of the week and a handful of data, what do you expect to see short term?
What I really like about this week is what's really not being spoken about. I like the pop in wholesale inventories, and I like the reduced deficit for the goods trade balance.
Okay.
These are the things that will force the Atlanta Fed to increase their Q1 GDP outlook when they redo the model tomorrow. Right now it's running at 1.0%. I think after those numbers are factored in, we'll probably look 1.5, 1.6%, which is a big deal coming on top of a fourth quarter that's now 2.1 instead of 1.9, because a two handle is a whole lot nicer than a one. This allows the Fed, which they've been talking probably a little too much, but this allows the Fed the cover they need in order to maintain the rising rate environment, which will support the banks. We've seen the banks kind of drop off a little bit in the last quarter or so, especially the last month. This will allow the banks to resume their march, because if we're going to go anywhere, we're going to be led by the banks, we're going to be led by the transports, and we're going to be led by Walt Disney, which I'm long.
Well, so you mentioned those sectors, so I do want to talk about what we've been seeing in sectors. We saw the transport turn higher earlier this week, and energy's been trading in an interesting pattern given where oil prices are. So have you changed your position on any of the sectors in the short term?
Energy's had a real rough year to date, real rough month. Energy's been tough, but you saw what President Trump did as far as deregulation goes just this week. That could be something of a turning point. We've had a little bit of disruption in supply from Libya. OPEC's talking about extending their production freeze or cuts, whatever you want to call it. If the WTI crude can hold that $47 support level, which right now it's looking pretty good.
And last but not least, since we have limited time, I do want to ask you about what we're seeing across the Atlantic. Now, the Article 50 of the Lisbon Treaty triggered the beginning of the Brexit process. Now, that will take a long time, but we've seen the effect it's had on the British pound. And in terms of trade and politics with the U.S. as well as the EU, what do you expect to see there?
You know, it doesn't seem like it's impacting the U.S. markets like you might have thought, I don't know, 6 months to a year ago. I would think that you might see a strengthening of the British pound coming out of this, because it's already priced for disaster. It came in on June 23rd. It came in about a couple months later, then out a little further. It's been up against $1.25 resistance for quite some time. I think as President Trump and Steve Mnuchin try to talk the dollar down a little bit, you'll probably see an increase in value for both the euro and the pound. I think what you do then is you avoid British exporters such as Unilever or Diageo. And if you're a British investor or someone who invests in Great Britain, you might want to stay to the small caps or the mid caps that basically have a domestic microeconomy within that island. I think it's interesting, but I don't think it will have at least U.S. repercussions to a large degree.
Okay, Stephen, well, it's always a pleasure and a treat to have you here at the Exchange. So thank you so much for joining me at the end of the first quarter.
Thank you, Remy.